The IRS doesn't care if you're busy. They don't care if your accountant ghosted you, and they definitely don't care that you meant to file on time. This is Stephen Young, host of the Savvy or Surrender podcast, and this is episode number 5. Stick around to find out what the IRS does care about. All right, so let's talk about some harsh truths about compliance. Now, procrastination can be very expensive with the IRS. Penalties, interest, not to mention the stress that's on your shoulders that you may not even really realize what happens as you are late filing. Some examples. If you file late, there are automatic failure to file penalties that are going to get applied to your account. As well as if you pay late, that interest is going to stack up, and they're going to charge you interest on what you owe. Not to mention, they're going to charge you interest on those penalties as well. And if you're not keeping good records, there's going to be some major red flags that the IRS is going to figure out. And they don't care about your story, your struggles, or your excuses, only about your numbers. So one example I have is a client that came to me. They had not filed in 7 years. So we had to file from 2018 all the way to 2024. They had, the husband had a stroke, and then they moved. Then there was COVID. Then they had another stroke. Then the wife got into, had a medical emergency. So there were all of these different things going on. There were reasons why they hadn't filed. But at the end of the day, the IRS doesn't care. And so when they came to me, we had to start getting everything organized and recreating these records that had been in a different state, a different bank than they were using anymore, and try to rebuild all of those, the income, the expenses. One was a business owner, one was W-2, but with a lot of expenses that she was trying to figure out what she could do with those and how we could maybe apply some of those things to her W-2 commission. And so as we started to separate those out, and she's getting letters now from the IRS with these huge penalties, and then from her old state where they were sending out information, because oftentimes the states are much more proactive than the IRS. The IRS has 60 million or 100 million taxpayers that they have to deal with. The states have far less, obviously, depending on what state you're in. So it is not unusual for the states to come after you before the IRS. And so all of those interests and penalties that she was getting were amounting to thousands and thousands of dollars. And that was just at the state level that they were coming up with things. They decided to estimate what their tax due amount was. And when they weren't answering the letters, next thing you know, they're starting to lien their properties. So not doing it, not handling your taxes, whether you believe taxes are legal or not, doesn't really matter. I'm not going to tell you that I disagree that taxes are not they're not legal according to the Constitution or whatever. I'm not going to argue with that. All I know is I don't look good in orange, and I would prefer to not wear it. And so I'm going to follow the voluntary law, right? I see Facebook comments about that all of the time. Whatever. I don't care if it's legal or not legal. As a citizen, I'm going to pay it. I'm just going to pay as little as I am legally liable to pay. Let's move on from that case and penalties and taxes, and let's start talking about what exactly can get you audited. This episode of the Savvy or Surrender podcast is brought to you by SavvyCEOalliance.com. I've created a group of people coming together that are looking to be more savvy in their business. So go to SavvyCEOalliance.com. You can find some different training modules. As I build it up, there's going to be more on profit first principles, tax strategies, marketing strategies. There's going to be monthly workshops. All of it is completely free. All you have to do is go to SavvyCEOalliance.com and join there in the school community, and we will see you there. Okay, so the big things that I have found that can get you audited. There are 5 areas that I have found. So big deductions with no substantiation, such as meals, vehicles, home office, Drastic income changes with no explanation. Rounding everything to the nearest hundred or even to the thousands. Messy bookkeeping. And you might be thinking, how does the IRS know? Well, we'll talk about that. And then mixing personal and business accounts. So let's dig into the first one. Big deductions with no substantiation. If you put on there all of a sudden that you had, $10,000 in meals, or you had $100,000 vehicle expense, or whatever it might be, maybe it's $10,000 in vehicle expenses, but you've got this larger amount than what was normal. Now, the big thing that you need to understand with all 5 of these bullet points here about what gets you audited is the IRS uses an algorithm now to be able to figure out their red flags, right? So they obviously have a ton of data from all different types of businesses, and they put you in a different code. When I do a tax return, I have to put in a specific code of what type of business you are. And it's pretty generic, to be honest. There's not a lot of codes. It's not like, there's 1,000 codes for different businesses. There's like, I don't know, maybe 100. I don't know exactly how many there are, but there's not a ton. Like, for example, a contractor, it's pretty much just contractor. There might be a couple of separations, but there's not, concrete and landscaping and plumbing and electrical and HVAC and gutters and all those other things that there are that you can be a contractor for. So as they collect that data, they understand that if you're making $100,000 in the bell curve, there are some that spend a lot of money in ads and some that spend very little money in ads. And there's some that they should know, or they can kind of see and get an average of how many miles that you are driving or what your vehicle expenses should be based on this age of a vehicle. So they collect all of that data. And if you're outside the norm, too far outside of the norm, then they're going to challenge that and they are going to audit that. Now, they may do a full audit if they feel like there's too many red flags, or maybe they just do they'll send you a letter and they'll say, hey, your mileage sounds off for the amount of income that you made. Send us your proof of your mileage. And then at that point, you need to show your mileage records. So taking big deductions and not being able to show any kind of proof for it can get you in a lot of trouble. If you get audited, you can't prove it. That's one big issue. The next one is drastic income changes with no explanation. If you made $1 million last year and then this year all of a sudden you made $100,000, or vice versa, you went from $100,000 to $1 million of income, that is automatically going to be a red flag and may generate an audit depending on other things. And then rounding everything to the nearest 100, nearest 1,000. If I always round numbers, if it's $5,000.28, I'm going to put $5,000. But if everything is $5,000, I did $10,000 in marketing. I had $5,000 in professional expenses. I had $3,000 in meals, right? You get the idea. If everything is a nice, simple round number, that is a definite red flag. You always need to have it be. Now, again, if it's legitimately $3,000, like that's how much you spent on, getting your transmission changed in your vehicle, then fine, it's legitimately $3,000. But more often than not, there's going to be some random extra numbers, right? It's going to be $5,012, or it's going to be $3,217, something like that. So you don't want to have the round numbers. And then messy bookkeeping. And again, as I mentioned before, the red flags, the algorithm, they're going to know that you have messy bookkeeping if you have these random categories, rounded amounts, right? They're going to see that, and their algorithm is going to tell them, hey, this is outside the norm, and you're going to get audited. And then the other part with bookkeeping and messy bookkeeping and when doing a tax return is bunching up your numbers. So if you have a lot of different items and you just put it all in, let's say, office expenses, rather than breaking it down. So now you have this huge office expense category, rather than just leaving it office expenses. Let's break that down into maybe 5 or 6 different categories, depending on what it is: printer expenses, subscriptions, QuickBooks, continuing education, office supplies, general office supplies, something like that, where we're breaking it into separate categories, and we can put all of that into the other category. When we do that, it lessens the likelihood of being outside of the norm of that bell curve. And so then we have a less chance of being audited. And then mixing personal and business accounts, I feel like this should be a no-brainer, but we never want to commingle our funds. We don't want to be going back and forth between business and personal and buying Dutch Bros or Starbucks, whatever it is, every single day for $3.50, or, I don't know what that is anymore, $6.50. Like, if it's always the same amount and it's clearly for one coffee, obviously that's you on your way to the office or to the job site buying Dutch Bros. That's not marketing. That's not networking. That's just you buying a coffee on the way there. Or you go to the gas station and maybe there's a $70 charge that's clearly gas, but there's also a $7 charge, and that's your breakfast burrito and a Celsius or something like that, right? So as you do those charges, clearly some of those are personal and some of those are business. We want to keep them separate. And then the other thing to talk about that are red flags there is, let's talk about the difference between an S-Corp and a Schedule C. So if you are a sole proprietor or a single member LLC, your business expenses and income gets reported on the Schedule C of the personal tax return, the 1040. That has a higher likelihood of being audited. Never mind the savings, right? We won't even talk about the tax savings here in this episode about the Schedule C versus being an S-Corp or anything like that. Just the likelihood of being audited increases if you keep it on the 1040 versus going in S-Corp or partnership or some type of an entity return. Statistically, that has been what's been proven. It's about 2/3 more likely to be audited on a Schedule C personal return than if you're on an entity return. Why that is simply because there's more auditors available for those Schedule C returns than there are for the other entity returns. Also, they figure if you are now an S-Corp, you're some type of an entity, you're more professional, you have accounting records, you have an accountant, you have a bookkeeper, so the records are more likely to be kept correctly versus a Schedule C. Maybe you're a hobby business, maybe you're just trying to put in a bunch of expenses to be able to get write-offs. So they flag you less and they have less availability of auditors on an entity return than on a 1040 Schedule C return. Okay, so now let's talk about being compliant versus it's not the same as playing it safe. So doing the bare minimum, like filing on time, paying your taxes, that keeps you out of trouble, but it doesn't necessarily build wealth. And so real compliance is being organized, being proactive, having a strategy in place to be able to pay your taxes and being ready to file your taxes every year. Now, it doesn't matter if you maybe do an extension. However, one of the big misnomers out there, or misunderstandings out there, I guess, is when you file an extension, whether it's an entity return that's due on March 15th, which, by the way, a lot of times have found that people don't know this. They become an S-Corp or a partnership, and they don't even know that their return is actually due a month earlier. It's due on March 15th. Or if you file an extension, so when you file an extension, you get 6 months, right? So instead of March 15th, it's due September 15th. And a personal return, which is normally due on April 15th, then if you file an extension, it is due on October 15th. That is simply an extension to file, not an extension to pay. So you are still supposed to estimate how much you think you owe and make a payment along with that extension. So it doesn't give you more time to pay. And that could be one area where they audit, but it's also going to be an area where you could get, you're going to have to pay interest because, yeah, you extended the time to file, but you still owed that money. And so you're supposed to pay that by that time, by March 15th or April 15th. And normally the return on March 15th, there's no money due normally. It depends on your state. Like in California, if you have an S-Corp, there's an $800 payment. In Idaho, we have a $20 payment due with an S-Corp return. So there may be a small amount due just depending on what type of structure you are. If you're a C-Corp, there's going to be more money due because of the 21% tax there. And then on the personal return, obviously, is where everything comes out, right? And we need to make a payment if we're going to extend to October 15th. The goal goal is to not just simply to avoid penalties, though, it's to maximize what you keep. And that's when we get into the profit first tax account allocation, as well as our tax liability savings and minimizing our taxes. And so really what I do with the savvy profit stacking is to maximize both. We want to have that profit first account for taxes. We want to put money in there because we're going to have payroll taxes. We're going to have to pay some FICA taxes with Social Security and Medicare. But then we also want to have money set aside for our withholding, our federal and our state withholding. And then as we use tax strategies, we will be able to save that money and maybe move it, reallocate it somewhere else once we know what our tax returns will actually be. Okay, so let's talk about how we stay out of trouble with the IRS or with your state. That could be the bigger issue, as we talked about. Number one is keeping your books clean. You should be in your QuickBooks, or you should have a bookkeeper or accountant that is managing your books, and they should be looking at it at least monthly, if not weekly, depending on your level of need, but definitely not yearly. I get a lot of people coming in and they say, I haven't looked at my QuickBooks. I've been paying for this subscription, but I don't know what to do. I haven't looked at it. And so now I have to clean up a year, 2 years, 4 years. Right now, I've got a couple of different clients that we're working on 4 years of their books. I even have somebody that I'm working on 2019 right now and trying to clean up those books. So the farther back we go, the more expensive it's going to be because the harder it is to get those records and reconstruct them. If we can manage it on a regular proactive basis, you're much safer with the IRS and it's going to be less expensive for you. So the other thing is to set up a separate account for your taxes. As I've talked about before with Profit First, we have a tax allocation account. We want to have that separate account there so that we know money is going in there. I can't tell you how many times I have people that are making six figures and they're making really good money, but when I tell them what their tax bill is, they ask where that money is going to come from. They don't have the money set aside. Can I make payments? You made $200,000 selling real estate last year, but now you're asking me if you can make payments of $200 to the IRS because you didn't set any money aside. That's not good. If you didn't make any estimated payments, and now I'm telling you, okay, now you owe $20,000 and you're asking if you can make the bare minimum payments, you're not set up correctly. And it's too late. If you're coming to me in March and we're doing your taxes and you're trying to figure it all out, it's too late. There's very little I can do reactively, right? The whole idea of tax strategy is to be proactive with it, not reactive. Okay, and then file and pay on time. Again, as I talked about earlier, if we file in March with an extension, we need to pay as much as possible. Even if we can't pay the full amount, the more we pay, the better off we are, because then there's less interest on what is due. And then that goes into also making the estimated payments. There are quarterly estimated payments, so 4 payments throughout the year that the IRS expects you to make. January 15th, April 15th, June 15th, and September 15th. Why those dates, I don't know. Obviously, it's not a true quarter where it would be like, April 15th and then what would it be, like July 15th or something? They don't follow the regular quarter system. So get an estimated voucher, go online and make an estimated payment. Now, if it's your first year in business, yes, you do have some leeway there because you don't know what those payments should be. But if it's your first year, let's say you're a real estate agent and it's your first year in business and you're making sales, clearly you're making money and you should be setting some of that aside. If you're a contractor, if you're a plumber and your books, according to the first quarter, you made $50,000, go ahead and set some of that money aside and make an estimated payment. Are you required to? Yeah, maybe you're okay on the requirement, but that doesn't mean you don't want to go ahead and make that payment so that you don't get penalized later, just in case. And then ask for help if you're in a crisis. If you're having tax issues, it is so much better to call the IRS or work with a tax professional to get something done and set up payment arrangements, especially, again, with the states. I don't mean to keep harping on the states, but I'm telling you, the states are much more aggressive than the IRS. They will come after you quickly. But the IRS isn't going to wait either. They will come after you. They will figure out that you haven't paid taxes in a number of years, and they will start leaning your properties. They will just confiscate your bank accounts. The next thing you know, any money that's in there is gone. If you have an account with your son, I've seen this happen, where the son had a bank account with the mom on it. The mom and dad, primarily the dad, owed money in taxes, and the state confiscated the son's bank account because the mom's social security number was attached to the son. The son had nothing to do with it. He wasn't living at home. He was over 18. He was working his own job. He gets paid, and the state took all of the money. I almost said stole because honestly, that's how I felt about it. But they took all of the money out of his bank account simply because the mom was on that checking account as well, and her social security number was attached to the husband who was not paying any taxes. If those things are happening, talk to a tax professional, talk to an enrolled agent like myself, a CPA, a tax attorney, somebody who is able to do a power of attorney, work with the state, work with the IRS, and be able to get that money back as quickly as possible if it's already happened. But do not be an ostrich. Don't dig your head in the pillow, in the sand, and pretend it's just going to go away. Because the biggest issue I see, I've had people crying in my office when I tell them what they actually owe or that they're getting money back. Or one client just recently hadn't filed taxes in 5 years. Well, the IRS is only required to pay you money back. You give you your refund over 3 years. So years 4 and 5, she actually was getting a refund, and the IRS is not required to give it to her because she didn't file on time. She could have gotten money back. So not only is she crying because of the relief of having this handled and gotten all of these back taxes reported and done, but she could have gotten thousands of dollars back, and the IRS isn't required to give it to her. So for those reasons and many more, you want to work with a professional if you need to, if you're in a crisis. Don't just think it's going to go away, because I promise you, the government is not going to go away. Thank you for joining me on today's episode, and I want to issue you a challenge. Maybe it's tax related, maybe it's bookkeeping related, maybe it's simply in your business related, something that you've been putting off, something that might bite you later on. What is it you are holding out on? You're being that ostrich, digging your head in the sand or in your pillows because you don't want to deal with it. Get it done. Handle it this week before you listen to the next episode. Go and handle it. Whether it's calling me, meetwithsavvy.com. We'll do a discovery call. I'll talk to you about your past taxes, bookkeeping, whatever it is. If you got other marketing challenge, things like that, and you want to talk that out as well, happy to do it. Meetwithsavvy.com. And we will figure out what we can do for you. And then intentions won't protect your profits. Savvy actions will. So let's be savvy. We do not want to surrender. And let's make it a great day.